The headline says a new Federal Reserve chair is coming in, Kevin Warsh, and that Washington has a plan to quietly reduce the weight of America's $39 trillion debt. That sounds like a government story. It is not only a government story, it is also a household story. It is a mortgage story. It is a saver story. It is a story about who owns fixed claims, who owns real assets, who owns debt at a fixed rate, and who is sitting in cash while the purchasing power of that cash is slowly drained away. When I study cycles, I do not begin with opinions. I begin with mechanics. And the mechanics are very simple. The government has an enormous debt burden. That debt is written in dollars. Your mortgage is also written in dollars. Your savings account is written in dollars. Your paycheck is written in dollars. Your rent, your groceries, your insurance, your repairs, your property taxes, and your interest payments all move through the same machine. So when the central bank and the government choose a path to reduce the real weight of debt, the consequences do not stop at the Treasury Department. They move through every balance sheet in the country. They move through yours. Most people do not see it because they think in nominal dollars. They look at the number. They say, my mortgage balance is still $300,000. They say, my savings account still has $100,000. They say, my payment is still the same. But the number is not the thing that matters. The purchasing power behind the number is what matters. A dollar is like a battery. The printed number on the outside does not change. It still says $1. But the charge inside the dollar changes. That charge is purchasing power. Inflation is the process by which the battery loses charge. The dollar does not look smaller. It simply does less. It buys less food. It buys less labor. It buys less house. It buys less insurance. It buys less medical care. And once you understand that, you understand how debt can be reduced without ever being formally canceled. Nobody has to go into the government's books and type 0. Nobody has to go into your mortgage portal and type 0 either. They do not cancel debt by deleting it. They cancel debt by making the dollars used to repay it worth less. That is the quiet mechanism. It has happened before. It is not mysterious. It is not new. It is not even particularly hidden. It is simply uncomfortable because it means the system has winners and losers. And most people have never been taught which side they are on. If you have a fixed rate mortgage at 3% and the value of the dollar keeps declining, you are paying back the bank with weaker and weaker dollars. If you have a large savings account earning almost nothing, you are holding the weaker and weaker dollars. That is the whole picture. One side is paying back debt with drained batteries. The other side is storing drained batteries and calling it safety. That is why the same policy that helps Washington reduce the real burden of its $39 trillion debt can also quietly reduce the real burden of your mortgage. It is not because anyone in Washington is trying to help you. It is because both debts are written in the same currency. You are not the target. You are a side effect. But in systems, side effects can be very powerful. If you are positioned correctly, the side effect helps you. If you are positioned incorrectly, the side effect takes from you. This is why I want you to stop thinking about this as politics. Politics is the theater on the surface. The real machine is debt. Interest rates, inflation, incentives, and time. The government owes roughly $39 trillion. That number is so large that most people's minds reject it. They hear it and move on. But the danger is not only the size of the debt, the danger is the refinancing schedule. A large part of government debt constantly matures and has to be rolled over. The old debt comes due, new debt has to be issued. If interest rates are low, the government can breathe. If interest rates are high, the interest bill grows very quickly. In 2025 alone, roughly $9.2 trillion of net debt rolled over. Imagine if your mortgage reset every year. Imagine that every 12 months your rate was changed to whatever the market rate happened to be at that moment. If rates were low, you were fine. If rates were high, your household budget would be under pressure immediately. That is the position of the government. It lives with a massive refinancing machine, and the Congressional Budget Office has already made the problem clear. Interest on the national debt is on track to become one of the fastest growing major items in the federal budget over the next decade. Not a bridge, not a school, not a new factory, not a new technology, just interest. Interest is money paid for past choices. It does not build anything. It does not feed anyone. It does not protect anyone. It is the cost of debt already taken on. When interest becomes one of the fastest growing parts of the system has to respond. It can respond openly or it can respond quietly. Open responses are politically painful. You can raise taxes, but the math does not work easily. You can cut spending. But the biggest programs are politically difficult to cut, and interest cannot simply be cut without default. You can grow out of the problem. That is the best solution. But it requires growth faster than the debt burden, and that is not something you can simply order into existence. So the system tends to choose the path that is least visible. That path is financial repression. Financial repression means that interest rates are held below inflation for long enough that debts shrink in real terms. In simple language, the battery leaks faster than it charges. Your bank may pay you interest. That interest is the charge, but inflation drains the battery. If inflation is higher than the interest you receive, your money is losing real power. Even if the account balance rises slightly, you feel safe because the nominal number is stable, but the real number is declining. Governments like this mechanism because it reduces debt without admitting default. Bondholders get paid, banks get paid, savers get statements, everything looks orderly, but the dollars returned later have less purchasing power than the dollars lent earlier. That is how the burden shifts. The borrower benefits, the lender loses. And in a financial repression cycle, the largest borrower is the government. This is what happened after World War II in 1946. The federal debt was about 106% of GDP. Many people believed the country was financially trapped, but over the following decades, the debt-to-GDP ratio fell dramatically. It did not fall because the debt was simply paid off in the way a household imagines paying down a credit card. It fell because nominal growth, inflation, and controlled interest rates changed the real weight of the debt. The Treasury paid its obligations, but it paid them in dollars that lost charge over time. This is why history is useful. History does not repeat exactly, but it teaches the mechanics. After World War II, short-term rates were kept low for long periods while inflation rose in waves. There were controls and regulations that limited what banks could pay depositors. Regulation Q capped deposit rates. That meant savers could not easily earn enough to keep up with the loss of purchasing power. Pension funds and insurance companies were steered into holding government bonds. The system did not say, "We are taking your purchasing power." It simply created conditions in which purchasing power moved from savers and creditors toward borrowers and asset owners. That is the important point. Nobody has to announce the transfer. The transfer happens through the structure. If you were a saver holding cash, you lost quietly. If you owned a fixed-rate mortgage tied to a real asset, you benefited quietly. You borrowed strong dollars and repaid weaker dollars. The house remained real. The debt remained fixed. That is a powerful combination. This is why a fixed-rate mortgage at a low rate can become one of the best assets on a household balance sheet during an inflationary debt. Management cycle. Most people are taught to hate debt. That is understandable. Bad debt destroys people. Variable rate debt can destroy people. Consumer debt can destroy people. Debt used to buy things that do not produce value can destroy people. But long-term fixed-rate debt attached to a productive or real asset is different. It has a very different character. It creates an asymmetry. Your payment is fixed. The asset may rise with inflation. Your income may rise with inflation. Your rents may rise with inflation. But the debt service does not rise. That gap is where the benefit appears. If you own a home with a fixed-rate mortgage below 5%, especially if it is near 3%, you have locked in a liability that can be repaid with future dollars that are likely to have less purchasing power. That does not mean you should be reckless. It does not mean debt is good in every situation. It means you must understand the type of debt you own. All debt is not the same. A 3% 30-year fixed rate mortgage is not the same as credit card debt at 20%. A fixed liability against a real asset is not the same as floating debt against a depreciating car. Principles require distinctions. Without distinctions, people follow slogans, and slogans can be expensive. Some people were told to pay off every mortgage early no matter what. That can be emotionally satisfying. It can reduce anxiety, but emotions and economics are not the same. If the central bank is trying to manage the government's debt burden through inflation and lower real rates, then accelerating the payoff of a low fixed-rate mortgage means you are giving back the advantage. You are taking today's stronger dollars and handing them to the bank early. You are returning fresh batteries while the system is preparing to drain them for you. That may feel responsible, but the math can be unfavorable. This is especially true when the alternative is holding cash at a large bank, earning almost nothing. Look at the saver. The saver thinks, "I am being prudent, I am holding cash, I am avoiding risk." But if the savings account earns 0.01% and inflation runs above that, the saver is losing purchasing power every day. The bank takes the deposit, the bank lends at higher rates, the bank earns the spread, the depositor earns almost nothing. And the depositor calls that safety. That is not safety. That is convenience combined with slow erosion. Safety must be measured in purchasing power, not in account stability. If you hold $100,000 in a big bank account earning almost nothing, the nominal balance may still show $100,000 next year, but the real value may be lower, the number is stable, the power is weaker. That is the trap. Financial repression always needs a losing side. It cannot make debt lighter for borrowers without reducing the real value of what creditors and savers receive. That is the mechanism. If the government pays creditors back in weaker dollars, the creditors lose purchasing power. If the homeowner pays the mortgage back in weaker dollars, the lender receives less real value, the borrower gains relative to the lender. So when people ask who pays for financial repression, the answer is simple. Cash holders pay, low yield, savers pay, long duration, bondholders pay, people who lend at fixed rates and receive dollars later pay. People who own real assets and fixed liabilities can benefit. Again, this is not morality, this is mechanics. The system does not care whether you were responsible. It does not care whether you worked hard. It does not care whether you followed every conventional rule. The system rewards the balance sheet that fits the cycle. That is why I always come back to the same idea. Know what cycle you are in, know what assets work in that cycle, know what liabilities help you and what liabilities hurt you, then act without emotion. The new Federal Reserve Chair, according to the story being discussed, inherits the same debt problem that every central banker in this environment must face. Whether one person can control the entire Federal Reserve is a separate question. The chair has influence. The chair does not act alone. But the direction of pressure is not created by one person. It is created by the debt. The debt creates incentives. The incentives create policies. The policies create winners and losers. That is how systems work. The public focuses on personalities, the serious investor focuses on pressures, and the pressure right now is the interest cost of the debt. If the government allows high real rates for too long, the debt burden becomes harder to carry. If it suppresses real rates, savers lose and debtors benefit. That is the trade-off. The attractive political feature of financial repression is that it does not feel like a tax at the moment it is collected. A tax arrives as a bill. Inflation arrives as a higher grocery receipt, a higher insurance bill, a higher rent, a higher repair cost. People feel it, but they often do not connect it to debt management. That is why it is effective. It is less visible than default. It is less direct than taxation. It is slower than a crisis. But over time, it is very powerful. Now bring this back to your mortgage. Suppose you have a $300,000 mortgage at around 3.25%. Your payment is fixed. If inflation moves through the economy, many of the nominal numbers around you move up. Your income may rise. If you own a business, your prices may rise. If you own rental property, rent may rise. If you own scarce assets, their dollar prices may rise. But the mortgage payment does not rise. That means the mortgage payment becomes smaller relative to your income and assets over time. In the first years, the payment may feel large. After 10 years of inflation, it may feel meaningfully lighter. After 20 years, it may be much lighter in real terms. This is the quiet mortgage bailout. No one announces it, no one congratulates you. The bank still receives the payment, but the real weight of the payment is reduced. This is why paying extra principal on a low fixed rate mortgage can be the wrong reflex in the wrong cycle. If the rate is low and fixed, and if the currency is being slowly debased, the debt is working for you. Not because debt is magic, because time. Inflation and fixed terms create an imbalance. The same imbalance that helps the government can help the homeowner, but the same imbalance hurts the person sitting in cash. That is why two people can live through the same economy and experience completely different outcomes. One person owns a home with a fixed-rate mortgage, productive assets, cash-flowing assets, and a high-yield place for liquidity. Another person keeps most of their wealth in a large bank savings account, earning almost nothing, pays extra on a low mortgage, and believes that being debt-free as fast as possible is always the correct answer. The first person is positioned for the cycle. The second person is being drained by the cycle. The difference is not intelligence. It is education about mechanics. So what should a thoughtful person actually do? The first thing I would do is study my own mortgage like an investor, not like a frightened borrower. I would pull the amortization schedule. I would look at the payment. I would look at the rate. I would look at the remaining term. I would ask one simple question. Is this debt a burden I should eliminate, or is it a fixed liability that helps me in an inflationary environment? If the mortgage rate is below 5%, and especially if it is near 3%, I would be very careful before accelerating payoff. I would not automatically send extra principal just because it feels virtuous. I would not automatically refinance into a shorter term just because someone told me 15 years is more responsible than 30. Responsible means understanding the trade-off. If you give up liquidity and repay cheap fixed debt early, you may be weakening your balance sheet. You may be reducing optionality. You may be taking capital that could have protected you or produced income and locking it into a home where it is harder to access. This does not mean never pay down debt. It means do not pay down the wrong debt for the wrong reason in the wrong environment. The second thing I would do is compare my cash yield to inflation, not emotionally, mathematically. I would pull the last bank statement. I would look at the interest line. If the number is effectively zero while inflation is several percent, I would call that what it is, a loss of purchasing power. I would then ask whether that liquidity could be kept in a better structure, maybe a high-yield savings account, maybe short-term treasury bills, maybe another cash instrument that pays a more reasonable rate. The exact vehicle depends on the person, but the principle is the same. Cash has a job. It should provide liquidity and optionality. It should not sit idle in a place that pays nothing while the currency is losing charge. Many people are careful about cutting a $5 expense, but they ignore thousands of dollars of lost purchasing power because it happens invisibly. That is a bad trade. The third thing I would do is think about home equity as stored energy. Home equity is useful, but it is not automatically productive if it sits trapped inside a house while the system is inflating and you have no liquidity. It may give you comfort but not flexibility. The question is not, how do I borrow recklessly? The question is, how do I access stored value intelligently without destroying the advantage of the low fixed rate debt? There are ways people try to do this. A home equity line of credit, a cash-out refinance in some cases, a reverse mortgage. Each has its own risks. Each has its own use case. Each can be misused, but the broader principle is important. Do not confuse equity with income. Do not confuse a house with a complete financial plan, and do not give up a valuable fixed-rate mortgage without understanding what you are giving up. The goal is not to have more debt. The goal is to use the structure of the cycle correctly. If you can convert trapped equity into assets that produce cash flow or preserve purchasing power, that can change the balance sheet. But if you convert it into spending, consumption, vacations, cars, or short-term comfort, you have taken a good position and ruined it. The tool is not the strategy. The principle is the strategy. A HELOC is not good or bad by itself. A cash-out refinance is not good or bad by itself. A reverse mortgage is not good or bad by itself. The question is what problem it solves, what risk it creates, and whether it improves the household balance sheet across a full cycle. That is how I would think about it. Not too emotionally, structurally. There are two paths from here. One path is the conventional path. Keep doing exactly what you were told. Pay extra on the mortgage because debt feels bad. Keep cash at a big bank because the branch feels safe. Wait for the news to tell you when the danger is over. Let inflation reduce your purchasing power while you believe you are being conservative. That path feels comfortable, but many dangerous paths feel comfortable in the beginning. The other path is to study the structure. Look at the post-war playbook. Look at financial repression. Look at the relationship between inflation and fixed debt. Look at the difference between nominal wealth and real wealth. Look at where your cash is. Look at what your mortgage rate is. Look at which assets can adjust to inflation and which cannot. Then reposition deliberately, not with panic, not with leverage you cannot handle, not with speculation, with principles. Because doing nothing is also a decision, and in a financial repression cycle, doing nothing often means accepting the role assigned to you. The saver who earns less than inflation, the depositor who funds the banking spread, the homeowner who gives up cheap fixed debt too early, the worker who believes a higher nominal balance means greater real wealth. The system does not punish you because it dislikes you. It punishes you because you are positioned in a way that allows it to extract from you. That is hard for people to hear, but it is better to hear it before the transfer happens than after. Most people think the Fed's decisions are abstract. They are not. The Fed's decisions influence the interest you earn on cash, the value of your mortgage, the price of your home, the valuation of your assets, the cost of your groceries, and the real weight of your debts. The central bank does not need to know your name to affect your life. A machine does not need to know the individual parts to move them. It only needs to change the pressure in the system. That is what monetary policy does. It changes pressure. And when pressure changes, weak structures break, strong structures benefit, and confused structures get redistributed. This is why I do not like simplistic rules. Always pay off debt, always hold cash, always avoid leverage, always buy the same thing, always trust the conventional answer. Life does not work that way. Markets do not work that way. Debt cycles do not work that way. The right answer depends on the environment, the price, the rate, the risk, the duration, the cash flow, and the behavior of the person making the decision. A low fixed-rate mortgage in a high-inflation environment is not the same as high-interest credit card debt. A savings account paying nothing is not the same as a short-term instrument paying a competitive yield. A house with trapped equity is not the same as a diversified portfolio of productive assets. Principles require context. Without context, rules become traps. So when I hear people ask whether the new Fed chair will cancel the government's debt, I think they are asking the wrong question. The right question is not whether the debt will be canceled. The right question is how the real burden of the debt will be reduced and who will pay for that reduction. If the answer is inflation and financial repression, then the next question is obvious. Am I positioned as the person whose burden gets reduced, or as the person whose purchasing power gets drained? That question is personal. It is also mechanical. If you hold low fixed-rate debt tied to a real asset, you may be on the favorable side. If you hold large cash balances earning below inflation, you may be on the unfavorable side. If you hold long duration bonds with payments that do not compensate you for inflation risk, you may be exposed. If you own scarce assets, productive businesses, cash-flowing real estate, and instruments that adjust better to inflation, you may be more resilient. But resilience is not a slogan. It has to be built. It has to be measured. It has to be stress-tested. The worst mistake is to hear this and become reckless. The second worst mistake is to hear this and do nothing. The intelligent move is to diagnose your balance sheet, know your debt, know your cash, know your assets, know your income, know your vulnerability to inflation, know your vulnerability to falling asset prices, know what happens if rates fall, know what happens if rates stay high, know what happens if inflation stays above the yield on your cash. A good investor is not someone who predicts the future perfectly. A good investor understands the system well enough to survive many possible futures. That is what matters. The big transfer ahead is not likely to arrive as a dramatic announcement. It will come as small monthly differences. The mortgage payment feels a little lighter relative to income. The savings account buys a little less. The real asset rises in price. The fixed payment stays the same. The cash earns less than it loses. The debt shrinks in real terms month after month, year after year. That is how big things happen quietly. Most people only notice after the outcome is obvious. By then, it is often too late to position. The time to understand a cycle is before it becomes visible to everyone. If you have a low fixed-rate mortgage, study it. If you have idle cash, measure it against inflation. If you have home equity, think about whether it is sleeping or working. If you have been following rules that were built for a different era, ask whether those rules still fit the current environment. The system is not going to send you a memo. Your bank is not going to call and say, your 3% mortgage has become a valuable liability. Your lender is not going to tell you that inflation is making your fixed payment less painful in real terms. Your savings account provider is not going to say, we are paying you almost nothing, while your purchasing power erodes. Institutions do not usually volunteer information that weakens their side of the trade. You have to understand it yourself. That is the point. Not fear, not anger, not politics. Understanding. Once you understand that the dollar is a battery, and that inflation drains the charge, the whole system becomes clearer. Debt is paid back with future batteries. Cash is stored current batteries. Fixed-rate debt benefits when future batteries are weaker. Savings lose when stored batteries leak faster than they charge. That is the mechanism. When the government tries to reduce the real burden of $39 trillion, it does not only affect the government, it affects every dollar-denominated promise. That includes your mortgage, that includes your savings, that includes your bonds, that includes your income, that includes your future. So the question is not whether you like the system. The question is whether you understand it well enough to avoid being used by it. I would rather know the machine is operating than pretend it is not. I would rather make decisions from principles than from slogans. I would rather keep a valuable fixed-rate mortgage and use my capital intelligently than rush to eliminate it because someone told me debt is always bad. I would rather move idle cash into a structure that pays me fairly than leave it in a place where the real value drains away. I would rather build a resilient balance sheet than complain that the system is unfair, because the system does not respond to complaint. It responds to incentives. It moves according to mechanics. And the mechanics right now are clear enough to respect. Debt is too large. Interest costs are too important. Political solutions are constrained. The quiet path is financial repression. That path rewards some balance sheets and punishes others. Make sure you know which one you have. That is the whole lesson. The mortgage is not simply a debt. In the right environment with the right rate, attached to the right asset, it can be a hedge against the very policy being used to manage the national debt. The savings account is not simply safety in the wrong environment. At the wrong yield, it can be the place where your purchasing power quietly disappears. The Fed is not simply setting rates, it is shaping the real value of every dollar you will receive and every dollar you will repay. Once you understand that, you stop asking whether the system is fair. You start asking how to be positioned, and positioning, not opinion, is what determines outcomes. The people who win in these cycles are not always the smartest. They are the people who understand the mechanism early enough and act with discipline. The people who lose are often the people who did what they were told, never updated their rules, and confused nominal safety with real safety. Do not be that person. Pull the mortgage schedule, check the cash yield, understand the equity, study the cycle, then make the changes that fit your own situation, your own risk, your own principles, and your own long-term security. That is how you move from being drained by the battery leak to owning the assets that benefit while it happens. YouTube equals set 1. The Fed's debt trick could quietly shrink your mortgage. A new debt cycle is forming, and most people are looking at it the wrong way. This Ray Dalio style breakdown explains how inflation, financial repression, and low fixed-rate mortgages can change who wins and who loses when Washington tries to reduce the real burden of America's debt. If you own a mortgage, hold cash, or worry about what inflation is doing to your savings, this is the kind of framework you need to understand before the next cycle fully unfolds. Disclaimer: this is an independent educational fan channel and is not affiliated with Ray Dalio or Bridgewater Associates. AI-generated voices are used for storytelling and educational purposes only. This content is not financial advice. Number Ray Dalio, number mortgage strategy, number financial repression, number inflation, number Federal Reserve, number debt cycle, number personal finance, number wealth protection, number fixed rate mortgage, number money system. Set 2. Your 3% mortgage may be the best asset you own. Most people were taught to pay off debt as fast as possible. But the rules change when inflation, debt cycles, and central bank policy reshape the value of money. This video explains why low fixed rate mortgage debt can become powerful in a financial repression environment, why cash savers often pay the hidden cost, and how to think in purchasing power instead of nominal dollars. Disclaimer: this is an independent educational fan channel and is not affiliated with Ray Dalio or Bridgewater Associates. AI-generated voices are used for storytelling and educational purposes only. This content is not financial advice. Number Ray Dalio style, number fixed rate at, number inflation hedge, number mortgage at, number debt cycle investing, number financial freedom, number hard assets, number cash trap, number Fed policy, number wealth mindset.